Usually when we talk about investing in the tech sector, there is this almost mandatory expectation of the cutting edge.
Right, yeah.
You know what I mean? You look at a stock ticker in the technology bucket, and your brain just immediately wants to see hyper-futuristic engineering.
Oh, absolutely. We want to talk about like neural networks or generative AI models.
Quantum computing.
Yeah, or at the very least, software that actually feels like it belongs in the 21st century.
Yeah.
We naturally gravitate toward the shiny new object.
Exactly. The flying cars of the stock market.
The disruption narratives, right? The stuff that makes the evening news and completely dominates the financial headlines.
But then you step away from Silicon Valley and you walk into the world of healthcare administration and secure corporate communications, and suddenly that futuristic high-tech vision just hits a massive brick wall.
It really does. It's jarring.
If you really look at the technological landscape of the American medical system,
yeah,
it is, honestly, it's a bit of a time capsule.
It is the absolute definition of a legacy quagmire. I mean, it's one of the most fascinating paradoxes in modern society.
How so?
Well, think about it. You have highly advanced, multi-million-dollar surgical robotics operating in a hospital, right? Delivering state-of-the-art care to a patient.
Yeah, literal sci-fi stuff.
Right. But then you walk 50 feet down the hall to the administrative offices, and the staff there is likely still manually typing patient data into a computer from a physical paper sheet they just pulled off a plastic tray.
That is wild to think about.
The clinical side is living in 2026. But the administrative side is, stubbornly stuck in 1998.
And that bizarre reality is the perfect entry point for today.
Welcome to the Deep Dive. Today, we are pointing our microscope at Consensus Cloud Solutions ticker symbol CCSI.
This is going to be a fun one.
We are unpacking their Q2 2026 earnings results, and the core tension we have to resolve today is just incredibly polarizing.
It really is. It's a tension that completely divides the market right now. Because when you hear the name Consensus Cloud Solutions, if you know the company's history, your brain might immediately jump to their original core product, which is eFax.
Oh, yeah. And let's be honest, the word fax makes a lot of modern tech investors immediately run for the hills.
Totally. It sounds like investing in blockbusters or, I don't know, dial-up internet.
Right.
So the central question for this deep dive is simple. Are we looking at a dying legacy business that is slowly and inevitably circling the drain?
Or are we actually looking at a highly profitable, cash-flowing healthcare tech company that is basically hiding in plain sight?
Exactly. Hiding precisely because the market is just too snobby to look past the word fax.
It's a profound question. And to answer it accurately, we have to strip away those immediate biases. We have to ignore the gut reaction to legacy terminology and do what the best analysts do.
Which is look directly at the raw data.
Right. Because the numbers tell a completely different story than the superficial narrative, but, only if you understand the mechanics, what you're actually looking at.
So let's start right at the top of the income statement, the headline numbers. For Q2 2026, CCSI posted consolidated revenue of $91.4 million.
Okay, let's unpack that.
Now, if you are just glancing at a notification on your trading app, you see that $91.4 million represents a 4.1% year-over-year increase. You also see it was a sequential increase of $2.9 million from the previous quarter.
Right, the surface level metrics.
And I'll be the first to admit, if I'm looking for a tech investment, 4.1% growth doesn't exactly make my heart race. It feels sluggish.
Well, sure. If you were comparing this to a hyper-growth enterprise software startup scaling from zero, yes, 4.1% looks almost stagnant.
Yeah.
But context here is absolutely everything. That 4.1% actually represents the strongest consolidated growth rate this company has posted since the fourth quarter of 2022.
Oh, wow.
Yeah, it is a demonstrable acceleration. But more importantly, taking that $91.4 million as a single consolidated number is incredibly deceptive.
It actively hides the real engine of this company, right?
Exactly. Because we aren't looking at a monolith here. Consensus Cloud Solutions is essentially upgrading two vastly different businesses under one roof.
And they are moving in completely opposite directions.
Yeah.
You have to split that $91.4 million into its component parts to understand the real trajectory.
You absolutely have to. We have the corporate segment and we have the Soho segment.
Let's look at corporate first, because this is where the thesis starts to get really interesting. Corporate revenue hit a record high of $60.5 million.
Which is massive for them.
That is a 9.3% year-over-year growth rate.
Mm-hmm.
They made a really big deal about crossing that 60 million threshold for the first time in company history.
And they have every right to take a victory lap on that specific metric. I mean, pushing a 9.3% growth rate, essentially near double digits in a B2B enterprise tech segment, is remarkably robust right now.
Because the environment is pretty hostile, isn't it?
Oh, totally. If we look at the broader macroeconomic environment in 2026, hospital systems and enterprise IT departments are under intense scrutiny.
Budgets are tight.
Very tight. CFOs are slashing software subscriptions left and right. So to grow enterprise revenue by nearly 10% in that environment means you aren't selling a nice-to-have luxury software.
Right. You are selling essential, mission-critical infrastructure.
Exactly. This corporate segment includes their highly secure, compliant data transmission services for massive hospital networks, enterprise clients, and heavy-hitting government agencies.
So this is the true growth engine of Consensus.
It is the core driver, yes.
But then we flipped a coin and we look at the other side of the house, the SOHO revenue. It came in at $30.9 million, which represents a decline of 4.7% year over year.
Yeah, that's the drag on the consolidated number.
Before we talk about the decline, if you're wondering what SOHO actually means in this context, it stands for small office, home office.
Right. This segment comprises individuals, freelancers, and very small, localized businesses.
Like who exactly? Give me some examples.
Think of a local real estate agent closing a few houses a month, right? Or a solo law practitioner who needs to send secure legal documents, or maybe a small independent corner pharmacy.
So folks who absolutely need a digital secure document transmission solution to operate legally, but they don't need the massive integrations.
Exactly. They do not need the complex integrations and dedicated account managers required by a 500-bed hospital network.
So if we look at the dynamic between these two segments, the corporate side is growing at nearly 10%, while the SOHO side is shrinking by almost 5%.
It's a stark contrast.
It's like looking at a twin-engine plane, where the pilot is intentionally throttling down the left engine, the SOHO side, to redirect all the available fuel, maintenance, and attention to a massive jet engine on the right, the corporate side.
That is the exact dynamic at play, and it is entirely validated by the management team's own commentary during the earnings presentation.
Yeah, they didn't shy away from it.
Not at all. Management is absolutely not running around with their hair on fire trying to save SOHO subscriber volume. Adam Varon, the CFO, was remarkably blunt about this.
Right, he used a very specific phrase.
He did. They are actively managing the SOHO revenue channel as a, quote, strategic cash engine to fund the accelerating corporate business growth.
See, that phrasing is what caught my attention.
Yeah.
Strategic cash engine. Wait, so does this mean they aren't even trying to turn the SOHO decline around?
They're completely accepting it.
Because if I'm an investor, seeing a revenue line bleed out by 5% feels instinctively like a massive red flag. Why wouldn't a company try to plug the hole and market to those small businesses to get them back?
Because trying to plug that hole would actually be a catastrophic destruction of shareholder value.
Really? How so?
This is where we have to separate retail investor psychology from disciplined corporate finance. In the old days of the tech boom, companies would burn millions and millions of dollars in marketing just to maintain top-line subscriber counts.
Just to keep the chart moving up into the right.
Exactly. Why? Because Wall Street loved the vanity metric of user growth, but the reality of the SOHO market is that the cost to acquire a new customer, the SAC, is incredibly high compared to how long they stay.
Ah, I see. So if they spend $50 on Google ads to acquire a local plumber, but that plumber only uses the service for 3 months,
and pays $30 total before canceling.
the company actually lost money on that user, even though their subscriber count temporarily went up.
Exactly. The lifetime value, or LTV, of a hyper-small business customer often doesn't justify the aggressive marketing spend required to get them in the door.
That makes total sense.
Consensus has realized this. Instead of fighting a costly, bloody battle for high-churn, small-fry customers, they simply pulled back the marketing spend. They are letting the absolute subscriber numbers fall naturally.
But if the subscribers are falling, how is it a cash engine? That sounds like an oxymoron.
Because the customers who do stay, the sticky, loyal small businesses who have used Consensus for years, are massively profitable.
Oh, because the overhead is gone.
Think about it. The infrastructure to serve a digital fax to a law firm is already built. The software is written. The servers are running. The research and development costs have been fully amortized.
So it's basically pure profit at this point.
Exactly. When you stop spending aggressively on marketing to replace the churn, the revenue from the loyal base drops almost entirely straight to the bottom line. It's a classic harvest strategy.
Wow, okay.
They are maximizing the contribution margin of a mature product. They are taking the pure cash generated by the Soho base and using it to hire elite enterprise sales reps and build advanced healthcare AI tools for the corporate side.
That is a fascinating pivot in strategy. It takes a lot of discipline for a management team to accept a declining top-line metric in exchange for bottom-line cash flow.
It takes guts, honestly.
And boy, does it show up in their profitability metrics. Let's look at adjusted EBITDA for the quarter. They posted $48.3 million. That yields an adjusted EBITDA margin of 52.9%.
We really need to pause and contextualize what a 52.9% margin means in the real world.
It's huge, right?
It's insane. Most healthy software as a service companies, the ones that get celebrated in the financial press, are absolutely thrilled to hit a 20 or 30% operating margin.
And Consensus is doing almost double that.
Consensus is converting more than half of every single dollar of revenue into adjusted operating profit. It is incredibly rare air.
And they noted that this 52.9% falls perfectly within their long-term target range of 50 to 55%.
Right. They are operating a highly tuned, hyper-efficient machine.
So we have a stabilizing top line being pulled up by the corporate engine and massive profitability. What does that mean for the actual cash hitting the bank account?
This is the best part.
Adjusted non-GAAP earnings per share came in at $1.49, up 2.1% year over year. But the metric that practically screamed at me from the page was the free cash flow.
A beautiful number.
They generated $25.5 million in pure free cash flow in a single 90-day period. That is a 25.1% jump compared to the exact same quarter last year.
It's staggering.
Now, the math here feels wild. If consolidated revenue only grew 4.1%, how on earth did free cash flow jump 25%? You can't just materialize cash out of thin air.
You can't, but you can free it from the balance sheet through rigorous operational discipline.
Okay, walk me through that.
There are two primary drivers for that massive cash flow jump that management highlighted. First, vastly improved management of their accounts receivable, and second, lower interest expenses on their debt.
Let's break those down, starting with receivables. Accounts receivable is simply money that customers owe the company for services already provided, right?
Yeah.
You sent the software, you sent the invoice, now you're just waiting for the check to clear.
Right. But in the enterprise healthcare space, hospital systems are notoriously slow payers.
Really? I would think they'd be prompt.
Oh, not at all. If a software company has sloppy billing practices or a timid collections department, those invoices might sit unpaid for 60, 90, or even 120 days.
That's a quarter of the year just waiting for money.
Exactly. On paper, the company recognizes the revenue, but in reality, that money is trapped on the balance sheet doing absolutely nothing. You can't use an unpaid invoice to hire an engineer or pay down debt.
So what did Consensus do?
By tightening in their collection processes, implementing better automated follow-ups, and holding clients strictly to their payment terms, Consensus is shrinking that window. They are turning recognized revenue into liquid cash in the bank much, much faster.
It's the difference between having wealth on paper versus cash in your wallet.
Beautifully said.
And what about the lower interest expenses?
That is the direct result of their ongoing, highly strategic debt management, which we will definitely explore in detail when we get to their forward guidance.
Okay, I'm looking forward to that.
But the short version is, by actively managing their capital structure and paying down specific tranches of expensive debt, they are literally writing smaller interest checks to bondholders every month.
Makes sense.
When you combine faster cash collections with smaller interest payments, you get a 25% explosion in free cash flow, even on modest top-line growth.
Okay, there is one more vital metric from the headline numbers we need to touch on. Corporate ARPA. The data shows corporate ARPA hit $305, which is roughly a 1% increase year over year. If you're sitting there wondering what ARPA is and why we should care about a measly 1% bump, let's define it.
Please do.
ARPA is just average revenue per account. It essentially tells you, on average, how much cash the company is successfully abstracting from each individual corporate client every single month.
And it is the lifeblood metric for any subscription-based enterprise business.
So a $305 corporate ARPA means that, averaged out across massive hospitals and smaller regional clinics, these enterprise clients are paying consensus over $300 a month.
Exactly. Now, you called 1% a measly bump, and in isolation it sounds small, but remember the scale here. You have to multiply that incremental increase across 67,000 corporate customers.
Oh, right. When you have 67,000 accounts, every dollar matters.
That small percentage adds up to massive absolute dollars. Furthermore, the directionality is what matters. In a tough economic environment where CFOs are trying to negotiate vendors down, the fact that consensus is pushing ARPA up
signals that they have pricing power.
Yes. It signals their customer base isn't just stable, they are actively increasing their usage volume or upgrading to higher tier, more advanced product packages.
That makes total sense. So to wrap up these headline numbers, the twin-engine plane is flying exactly how the pilot designed it.
Perfectly on course.
The Soho engine is being intentionally throttled down, but because they aren't wasting money trying to fix it, it's highly efficient and throwing off massive cash. The corporate engine is roaring at near double-digit growth. They are holding staggering 50+% profit margins, and they're generating mountains of free cash flow.
Exactly. When you strip away the biases, the raw data proves the business is highly resilient, immensely cash generative, and successfully executing a massive strategic pivot.
But numbers on a spreadsheet only tell you what happened. They don't tell you how or why it happened.
Right. You need the context.
You don't just magically get 9% corporate growth by sitting back and hoping hospitals buy your software. You have to secure massive institutional anchors.
You have to earn those contracts.
Now that we know the financials are a fortress, we need to look under the hood to see exactly what operations are fueling that corporate engine. Which brings us to the story behind the numbers.
Let's get into it.
And I want to start with a massive foundational catalyst that management spent significant time highlighting: the Department of Veterans Affairs.
I would argue that the VA mandate is the most significant operational development discussed in this entire earnings presentation.
That's a bold statement.
It is, but its implications stretch far beyond just one single contract.
Let's set the stage for how big this is. The Department of Veterans Affairs is the largest integrated healthcare system in the United States.
Massive footprint.
We are talking about millions of patients, hundreds of medical centers, and thousands of outpatient clinics. According to the data, the VA issued an internal policy formally mandating something called ECFax as its singular secure fax and document transmission solution.
A full system-wide mandate.
The rollout is currently 65 to 80% complete across their network, and management noted it will contribute a minimum of $9 million in guaranteed revenue for 2026 alone.
It's a huge win.
So what exactly is ECFax?
Think of ECFax as the militarized, enterprise-grade, highly secure, older sibling of their legacy eFax platform.
Okay, militarized is a good word for it.
It is specifically engineered from the ground up for government agencies and massive institutional requirements. A local real estate agent doesn't need ECFax.
Right.
But the VA, which handles highly sensitive, classified, and protected health information for millions of veterans, requires absolute, impenetrable security.
Right on for error.
ECFax provides military-grade encryption, immutable audit trails, and rigorous compliance tracking for every single document that moves through the ether.
Now, when a federal agency with the bureaucratic weight of the VA issues a, quote, policy mandate, what does that actually look like on the ground? Does it just mean they strongly suggest people use it?
Not at all. A mandate means it is no longer optional. The central authority in Washington has dictated that every single hospital, every rural clinic, every administrative office, and every pharmacy within the VA network must transition to this specific consensus product.
Wow, so no exceptions.
No exceptions. What we are seeing is the forced retirement of legacy on-premise infrastructure. Historically, hospitals had literal physical servers, heavy metal boxes, sitting in air-conditioned closets handling their fax traffic.
And the VA is just ripping those out.
The VA is tearing those out and pushing the entire ecosystem into the consensus cloud.
Which explains why Johnny Hecker, the chief revenue officer, referred to the VA as a true lighthouse customer. In the enterprise software world, if you can prove that your architecture can handle the sheer volume and the paranoid security demands of the U.S. military and the VA, you can walk into any private hospital boardroom in the country and say, you know, if it's good enough for the Department of Defense, it's good enough for you.
Precisely. It is the ultimate validation stamp. But the direct revenue from the VA is only part of the story. This is where we see the mechanics of what we call the halo effect in enterprise sales.
Tell me about this halo effect.
The team noted that this specific mandate is directly driving a highly qualified lead pipeline across other entirely separate government agencies.
Like it's contagious.
Exactly. But even more fascinating than that, it is forcing massive adoption among private government contractors and suppliers.
Wait, really? Why would a private independent contractor care what software the VA uses internally? If I sell medical supplies to the VA, why do I care how they fax things?
Because in modern supply chains, interoperability is everything. Think of it like this. It's like the VA just declared that, starting tomorrow, everyone in their organization will only speak Spanish.
Okay, I'm following.
If you are a private contractor, say, a third-party medical imaging center that does thousands of MRIs for veterans, or a massive manufacturer of prosthetics and the VA is your biggest client, you have to learn Spanish immediately.
You don't have a choice.
You need your internal software systems to talk to their systems flawlessly. If the VA is standardizing its entire communication protocol on ECFax, it highly behooves all of their thousands of private vendors to adopt a fully compatible, secure system to prevent document transmission failures.
Because if a document fails, an order gets lost.
It reduces friction in getting orders and, more importantly, getting paid. The chief revenue officer specifically mentioned they are in active conversations with private contractors to get them onto the ECFax platform simply because of this vendor dynamic.
So landing the VA isn't just landing one whale. It's not a single isolated win. It's a structural shift that forces the entire ecosystem surrounding the VA to adapt.
That's the power of the halo effect.
But let's be real, you don't just walk into the VA with a slick PowerPoint and walk out with a cloud contract.
Oh, definitely not.
To land federal contracts, you need a very specific, grueling type of security clearance. The presentation mentions FedRAMP certification. What is the reality of FedRAMP?
FedRAMP stands for the Federal Risk and Authorization Management Program. To call it a clearance almost understates it.
Is it that intense?
It is the absolute gold standard for cloud security in the United States government. To legally sell cloud services to federal agencies, a software vendor must pass agonizingly detailed security assessments.
What does that entail?
We are talking about hundreds of specific security controls, continuous monitoring, and third-party penetration testing. The data notes that Consensus holds a FedRAMP Class D certification, which was formerly known in the industry as FedRAMP High.
FedRAMP High. Just the name sounds intimidating. How hard is it to actually get that?
It is an incredibly high, almost insurmountable barrier to entry for most companies. Achieving FedRAMP High takes years of dedicated engineering and millions of dollars in compliance consulting and audits.
Wow. Years.
Yes. This is arguably the most massive competitive moat Consensus has. A scrappy, well-funded new startup from Silicon Valley cannot just walk in and pitch the VA on a slick new secure messaging app.
Because they literally aren't allowed in the building.
They legally cannot even sit at the table because they don't have the FedRAMP clearance. Consensus does. That certification alone makes their public sector revenue incredibly sticky and gives them a near monopoly advantage in bidding for further highly classified government contracts.
Well, the public sector and the FedRAMP moat are clearly massive structural drivers of that corporate growth.
Undeniably.
But securing that government pipeline just gives them stability. If they actually want to shed that legacy fax label and expand their footprint deeply into the private medical sector, they have to solve the fundamental data problem that is plaguing the rest of the healthcare system.
Right. They have to go beyond just transport.
And that brings us to the next evolution of the company and their recent doc.health acquisition.
This is where the narrative shifts from simply being a secure digital mail carrier to becoming an advanced intelligence layer within the healthcare system.
Let's look at the specifics of this deal. The data highlights a tuck-in acquisition Consensus made during the quarter. They bought a company called doc.health for approximately $4.3 million.
A relatively small deal.
Yeah. The financial breakdown is $2.355 million in immediate cash and $1.907 million in contingent consideration, meaning earnouts based on future performance. They also added 14 employees from this deal.
Okay, so a tiny team.
Now let's take a step back. $4.3 million is essentially couch change for a company like Consensus that generates over $100 million in free cash flow a year.
It's barely a rounding error.
Why is the executive team dedicating so much precious time on a quarterly earnings call to discuss such a tiny, seemingly insignificant acquisition?
Because the value of this acquisition has absolutely nothing to do with immediate top-line revenue.
Okay, then what is it about?
In fact, Adam Veron was incredibly transparent. He noted that doc.health will only add a microscopic $1 million in revenue this year and will actually have a negative $0.6 million EBITDA impact for the full year 2026.
Wait, so they are going to lose money on it in the short term?
They are. This was a purely strategic acquisition of highly specialized technology and elite talent. It is a classic buy versus build decision.
I see.
Consensus realized they needed a specific AI capability, and instead of spending 3 years developing it internally, they bought a company that had already perfected it.
Let's look at the talent side first, because they didn't just buy code, they bought leadership. They brought on a guy named Steve Tolle to lead a newly formed healthcare strategy and solutions group.
Yes, and his resume is incredibly heavy.
He is a 35-year veteran in healthcare technology, and he previously led AI-based radiology initiatives at IBM Watson Health.
That hire is a massive signaling mechanism to Wall Street and to their hospital clients.
How so?
When you hire a heavy hitter from IBM Watson Health, one of the pioneers in applying artificial intelligence to complex medical data to be your chief healthcare solutions officer, you are screaming to the market that you are no longer just transporting flat documents.
You're building an intelligent workflow engine.
Exactly.
The management team keeps mentioning that doc.health fits perfectly into their vision for something called the Harmony platform, and they obsessively talk about solving the problem of unstructured data.
Yes, that's the key phrase, unstructured data.
Here's the foundational question we have to answer. If we are living in 2026 and digital health records, massive EHR systems like Epic and Cerner are ubiquitous in every major hospital, why is anyone still relying on fax in the first place?
It's the most common question I hear.
Why hasn't the entire system just moved to a unified digital database? And how exactly is Consensus turning a flat, static fax image into something an AI can actually understand?
That is the million-dollar question that unlocks the entire Consensus investment thesis. To understand it, you have to understand the fundamental flaw in how American healthcare evolved.
Walk me through that.
Yes, massive hospital systems have spent billions of dollars installing monolithic EHR systems like Epic. But those systems are walled gardens.
Meaning they don't share well with others.
Exactly. Epic does not easily talk to Cerner. Cerner does not easily talk to MedTech. And more importantly, the healthcare ecosystem is infinitely broader than just mega hospitals.
Right. There are all those little feeder clinics.
A massive regional hospital constantly interacts with thousands of tiny, independent, highly fragmented entities. Local physical therapy clinics, independent nursing homes, specialized outpatient surgery centers, small rural labs.
And those smaller players absolutely do not have the millions of dollars required to install an Epic EHR system.
Yeah. No way. They are probably running their clinic on basic QuickBooks and simple scheduling software.
So how does this small rural clinic communicate vital patient information to the massive Epic-run hospital?
They can't send a direct database link. So they fall back on the lowest common denominator of secure, IPA-compliant communication. They send a fax.
Wow, so that's why it's still alive.
Whether it's a physical machine or a basic e-fax, the hospital receives it. But here is the critical bottleneck. When a hospital receives a digital fax, what they actually receive is a flat, unstructured image file.
Like a PDF.
Think of a PDF or TIFF file. It's essentially a digital photograph of a piece of paper.
Right. While a human can look at a PDF and read it, a multi-million-dollar Epic EHR system cannot.
To Epic, a PDF is just a block of dumb pixels.
The database needs structured data. It needs a specific string of text to go into the patient name field, a specific date format to go into the date of birth field, and specific numerical diagnosis codes.
Precisely. Historically, the only way to bridge that gap was brute force human labor.
So someone literally typing it out.
Yes. A highly paid administrative worker at the hospital would have to pull up the fax image on one monitor, open the Epic database on the other monitor, and physically type the information from the image into the database fields.
That sounds excruciatingly slow.
It is excruciatingly slow. It is prone to catastrophic human error, like typing a wrong dosage or a wrong insurance code, and it is incredibly unsustainably expensive in terms of labor hours.
Okay, I see the friction perfectly now. So where does Consensus, doc.health, and this new AI Harmony platform come in to solve this?
The CDO, Scott Chirici, mapped out the exact workflow during the call. When thousands of faxes come in containing patient referrals or prior authorizations, Consensus's Harmony platform sits directly in the middle as an intelligent toll booth.
So it intercepts the fax.
It intercepts that incoming dumb fax image. But instead of just routing it to an administrator's inbox, it deploys advanced optical character recognition and sophisticated natural language processing AI models specifically trained on medical jargon.
So it's not just taking a picture.
No, the AI essentially reads the document like a human would.
It actually understands the context. It realizes, John Doe's the patient, Dr. Smith is the referring physician, and M54.5 is the ICD-10 code for lower back pain.
Exactly. It extracts that chaotic, unstructured text and instantly formats it into structured, machine-readable data.
And then what?
It then automatically injects that structured data directly into the correct fields within the hospital's Epic or Cerner system, bypassing the human typist entirely.
That is incredible. They are essentially acting as the universal translation layer between the low-tech fragmented sender and the high-tech monolithic receiver.
That's a perfect way to phrase it.
They are automating the clinically adjacent grunt work, the referral management, the agonizing prior authorizations that falls completely between the cracks of traditional EHRs.
And doc.health was literally a workflow platform developed by a practicing medical professional to solve exactly these specific administrative bottlenecks.
No wonder they bought them.
It is a phenomenal strategic fit.
But having great technology is only half the battle, right? You have to convince hospitals to buy it.
Oh, absolutely. Sales is a whole different beast.
And during the Q&A portion of the earnings call, an analyst smartly pointed out that hospital systems are currently facing severe budget and volume challenges. They asked how Consensus manages to sell software when hospitals are clearly reluctant to spend money and are taking months to make vendor decisions.
It's a very real hurdle.
Yeah, if a hospital is operating on a razor-thin 1% margin, they aren't going to buy a new software suite just because it has the letters AI slapped on the brochure.
Yeah.
How does Consensus counter that deep-seated financial hesitation?
By entirely abandoning the traditional feature set sales pitch and leaning exclusively into strict, mathematically quantifiable ROI return on investment.
So speaking the CFO's language.
Exactly. When hospital budgets are suffocating, you absolutely cannot sell them a nice-to-have quality-of-life software upgrade. You have to sell them a financial lifeline.
A solution that objectively pays for itself.
Yes, in hard dollars within the same fiscal year. The Consensus sales team's pitch in this environment is brilliant. They walk into a hospital CFO's office and say, look, we know your budget is frozen, but how many full-time administrative employees do you currently have sitting in a back room manually retyping data from thousands of incoming referral faxes?
And then they offer to automate it.
They say, we can automate 80% of that manual labor tomorrow. Yes, our Harmony platform costs X amount per month, but it instantly saves you 3X in reduced labor costs. And more importantly, it drastically reduces the number of denied insurance claims caused by human typos.
Wow. That changes the conversation entirely. You aren't asking for a budget allocation. You're offering an immediate cost reduction strategy.
It's an offer they almost can't refuse.
In a tough macro environment, a hard dollar ROI pitch is practically the only way to get a purchase order signed.
Exactly. It aligns perfectly with the financial pressures their clients are facing.
So we've seen the incredible stability of the public sector pipeline, and we've unpacked the mechanics of their healthcare AI strategy. Now we need to see if it's actually working to keep customers loyal.
The retention metrics are everything.
Let's move to the health of the enterprise base and how management is allocating all the cash this machine is generating.
The internal health of that corporate base is the single most important indicator of long-term viability.
Now, looking at the data, the metrics are incredibly strong. Total corporate customer accounts grew to 67,000, representing a 9.4% increase.
Solid logo growth.
But the metric that really matters, the one that separates decent SaaS companies from great ones, is net revenue retention, or NRR. Consensus reported that NRR climbed to 103.1%, up from 102% in the previous quarter.
That's a beautiful trend line.
Now, if you are a listener who doesn't spend their weekends reading SaaS accounting textbooks, let's break down why an NRR over 100% is the holy grail.
I'd love to. Net revenue retention measures the financial behavior of your existing customer base over time, completely isolating them from any new sales you make.
Yep.
It answers the question, if we fired our entire global sales team today and never acquired a single new customer, what would happen to our revenue from the people who already use our product?
Wait, so walk me through how that actually calculates out.
Yeah.
Imagine we have a bucket of 100 hospital clients starting on January 1st.
Yeah.
And collectively, they pay us exactly $100,000 a year.
Perfect analogy. Over the next 12 months, reality sets in. Some of those hospitals in your bucket might unfortunately cancel their contracts entirely. That is your churn.
Right.
Others might face budget cuts and downgrade to a cheaper basic tier. But on the positive side, other hospitals in that same bucket will upgrade to premium features, buy more user licenses as they grow, or adopt advanced add-on products like the Harmony AI suite we just discussed.
Okay, so if your NRR comes in at exactly 100%, it means the financial gains from the upgrades perfectly canceled out the financial losses from the downgrades and the churn. You got it.
That original bucket of 100 customers is still paying you exactly $100,000, even if a few left.
Exactly. So an NRR of 103.1% means that exact same static bucket of existing customers is now paying you $103,100.
So it's growing on its own.
Yes, the revenue generated from your existing historical base is growing organically by 3.1% before you even account for the new logos the sales team is bringing in. It is the ultimate proof of product stickiness.
It proves that customers aren't just tolerating the software. They are finding it so fundamentally valuable to their daily operations that they are actively willing to spend more and more money with Consensus year after over year.
The chief revenue officer noted this metric is the ultimate validation of their land and expand strategy.
Which means?
They land an enterprise account with basic secure transport, and then they successfully embed themselves deeper into the hospital's workflow, capturing more data volume and upselling intelligence tools. That is a beautiful business model. And as they execute that model, generating mountains of cash from these expanding enterprise clients, alongside the highly efficient Soho cash cow, they are faced with a massive corporate dilemma.
A good problem to have.
What do you actually do with all this money? This brings us to capital allocation. The transcript shows that during the quarter, management went into the open market and repurchased 300,000 shares of their own stock, spending roughly $9.6 million.
Which is an aggressive move and a massive signal of internal confidence from the executive team regarding their valuation.
And they are clearly just getting started. The board of directors officially upped the share repurchase authorization to a massive $200 million.
Wow.
As of this report, they have about $118 million left in that buyback war chest to deploy whenever they want. We are going to talk about the profound implications that has for the stock price in our bottom line assessment.
It's going to be a key point.
But before we get there, I want to push back on another much more questionable capital allocation decision buried in the data.
Okay, let's hear it.
The financials highlight a $5.3 million non-cash gain related to a $10.5 million investment they made in an external AI partner company.
Right, I saw that.
Now, Scott Terrici, the CEO, was very vocal on the call. He explicitly warned investors, stating, quote, "These kind of investments are inherently risky." So I have to ask, is Consensus Cloud Solutions quietly playing venture capitalists with shareholder money?
That's a fair question.
Why is a highly disciplined, cash-flowing, secure fax and workflow company placing risky, multi-million-dollar speculative bets on private AI startups?
It is a completely valid concern. Whenever a non-core business starts dabbling in VC investments, alarm bells should absolutely ring.
Exactly.
But it's important to understand the specific nuance and strategic imperative here. First, Terrici clarified this was not a blind speculative venture capital bet hoping for a 100x return.
So they weren't just throwing darts at a board.
No, he noted this specific startup is a core technology partner. It is one of the third-party engines they actively utilize in conjunction with their Clarity product suite. So this is a strategic investment to secure their own technological supply chain. They're taking an ownership stake in a partner they fundamentally rely on for their core healthcare AI workflow strategy.
Oh, I see. So they have a vested operational interest in ensuring this partner has the capital to survive and succeed. Because if the partner fails, Consensus's own product suffers.
Precisely.
It's almost like a manufacturer buying a stake in their most critical parts supplier.
Exactly. It's defensive as much as it is offensive. Second, we need to demystify the accounting behind that $5.3 million gain.
Because it sounds like free money.
Right. You might be thinking, what does an unrealized non-cash gain actually mean for their bank account? Did they just make $5 million? The answer is no. This is purely an accounting mechanics issue.
Walk me through the reality of it.
They made the original cash investment of $10.5 million a few years ago. Because the AI startup is a private company, Its exact daily valuation is impossible to determine. It's not trading on the NASDAQ. However, during this quarter, that private startup executed a priced funding round. This means large, outside venture capital firms put new money into the startup at a specific, newly negotiated valuation.
And the value went up.
Yes. Based on the math of that new, higher valuation, Consensus's original slice of the pie is now theoretically worth close to $16 million.
Yep.
Under generally accepted accounting principles, GAAP rules, Consensus is legally required to record that theoretical increase in value on their balance sheet, which generates a $5.3 million gain on paper.
But they can't actually spend that $5.3 million. Tarishi was specifically warning investors not to model this into their cash flow projections.
Exactly. He was being remarkably transparent, almost to a fault. He wanted to ensure Wall Street analysts didn't build this $5.3 million into their recurring operational models.
Because it's not real cash yet.
Right. He reminded everyone that the world of private tech startups is volatile. Valuations can get slashed in future down rounds just as easily as they go up.
Weird point.
But strategically, it proves that Consensus is willing to judiciously deploy capital to secure its technological edge in the AI space without having to build every single algorithm from scratch internally.
All right, let's take a breath and recap. We have deeply dissected the raw financial data. We've unpacked the powerful story of the VA FedRAMP mandate forcing vendor compliance, the healthcare AI pivot turning static faxes into structured epic data, the hyper-sticky enterprise retention metrics, and the strategic rationale behind their AI investments.
We've covered a lot of ground.
With all of this operational momentum building and all this free cash flow sloshing around the balance sheet, what exactly is the executive team promising the market for the rest of the year? This brings us to management guidance.
Forward guidance is always the most fascinating part of an earnings call.
It's where the rubber meets the road.
It is where the real psychological battle between management's internal projections and Wall Street's insatiable expectations is fought.
Let's look at the official numbers. Management fully reaffirmed their full year 2026 guidance. They are projecting total revenue to land between $350 million and $364 million.
Okay.
Adjusted EBITDA is targeted between $182 million and $193 million, and adjusted earnings per share between 5.55 and 5.95. They also gave us specific Q3 projections. Revenue of $89.2 million to $93.2 million, and EBITDA of $45 million to $48 million.
Now, the operative word you used there is reaffirmed.
Right.
They simply repeated the exact same ranges they gave at the beginning of the year. They did not officially move the goalposts higher in their press release.
So they didn't raise.
But if you listen closely to the tone and the specific phrasing Adam Vuren used during the call, he essentially executed what we in the industry call a beat and whisper raise.
A beat and whisper raise. I love the cloak and dagger sound of that. How exactly does a CFO execute a whisper raise without formally changing the numbers?
It's an art form. While officially maintaining the wide range to protect themselves legally, Vuren explicitly stated on the call that, based on their massive first-half performance, they now expect full-year revenues to track firmly between the midpoint and the absolute high end of the guidance range.
Oh, I see.
Furthermore, he verbally guided that EBITDA and EPS are expected to track slightly above the midpoint of their respective ranges. He is using verbal commentary to guide the analyst models higher without legally changing the printed brackets.
But here is my fundamental question. If Q2 was truly as phenomenal as we just discussed, record-breaking corporate revenue, massive 25% jumps in cash flow, exploding NRR, why play coy?
That's a fair point.
Why use a whisper? Why not just boldly, officially raise the guidance ranges and let the stock rip? Are they just sandbagging to guarantee they look like heroes when Q3 and Q4 results come out? Or are there genuine structural headwinds terrifying them behind the scenes?
It is a combination of two things: a deeply ingrained conservative management philosophy and a few very real, very specific cost pressures that are structurally programmed to hit their income statement in the second half of the year.
Let's look at the philosophy first.
Scott Turicchi addressed this exact dynamic directly during the analyst Q&A. He bluntly stated that it is simply not Consensus's historical practice to alter official guidance ranges mid-year, regardless of how strong a single quarter might be.
They just don't do it.
They prefer a set-it-and-forget-it approach. Guide wide, once in Q1, and then use verbal color on quarterly calls to indicate where they are tracking within that established framework.
Which prevents them from looking foolish if the macroeconomy suddenly implodes in November.
Exactly. It manages Wall Street's volatile expectations and prevents management from getting boxed into an impossibly high corner if there's an unexpected shock to hospital budgets.
But more importantly, you mentioned headwinds.
Yes. There are two major unavoidable margin pressures hitting their profitability in Q3 and Q4. First, headcount expansion.
The new hires.
Terici admitted that their internal hiring process was slower than budgeted early in the year. Because they didn't hire people as fast as planned, their Q1 profit margins looked artificially inflated.
Oh, because they were saving on payroll.
Right. But they finally caught up in Q2, successfully onboarding 32 new employees.
And the data notes those hires were primarily expensive, high-level roles in the go-to-market sales force and the new healthcare solutions groups.
Exactly. And now that those 32 high-salary employees are on the books, their salaries, benefits, and travel expenses will represent a full quarter run rate expense in both Q3 and Q4.
So bill comes due.
That increased payroll will mechanically drag down EBITDA margins compared to the unusually lean first half of the year. The second headwind is a bizarre accounting quirk regarding their corporate audit fees.
I saw this. The notes mention a $1.3 million sequential increase in expenses purely due to the timing of the year-end audit. How does an audit cost an extra $1 million just because of timing?
Most public companies utilize accrual accounting to spread the massive multi-million-dollar cost of their external auditors evenly across all 4 quarters of the year, so it doesn't create a massive profit crater in one specific month.
Right, you smooth it out.
However, Consensus currently accounts for the specific audit fees as they are actually incurred with the accounting firm. And since the bulk of the intense audit work happens at the end of the year, it heavily loads those massive invoices into the third and fourth quarters.
So you have a guaranteed $1.3 million hit to profitability in Q3 and likely again in Q4 simply due to the timing of when the accountants send the bill.
Exactly. So they aren't necessarily sandbagging the guidance. They just mathematically know that the back half of the year is structurally more expensive to operate.
And, of course, we can't forget the intentional unwinding of the Soho channel. They explicitly guided that Soho revenue is projected to decline by 5 to 7% over each of the next 2 quarters.
Which is a clear acceleration of the decline compared to the 4.7% drop we saw this quarter.
They are ripping the Band-Aid off.
Again, they are being brutally transparent as they actively pull remaining marketing dollars away from Soho to fund the salaries of those new corporate AI enterprise reps. The Soho subscriber base will naturally bleed out a little faster. They are accepting that reality.
Okay, before we bring all of this together for our final bottom line assessment, we absolutely must talk about the balance sheet, specifically the elephant in the room for any legacy tech company, the debt.
Always the debt.
Total debt currently sits at $558 million. The net debt to EBITDA ratio is sitting at 2.45x. Let's be honest, $500 million in debt sounds terrifying to a retail investor. Is that a dangerous amount of leverage for a company of this size?
In the context of corporate finance, absolutely not.
Really?
For a company generating roughly $106 million in pure annual free cash flow, carrying $500 million in debt with a 2.45x net debt to EBITDA ratio is considered remarkably healthy and highly manageable.
Let's contextualize that ratio. What does 2.45x actually mean in practical terms?
It means that if Consensus halted all growth, froze the company exactly as it is today, and dedicated every single penny of its operating profit exclusively toward paying down debt, it would take them less than 2.5 years to be completely debt-free.
Oh, that really puts it into perspective.
Wall Street bond analysts generally do not start sweating or downgrading credit ratings until that ratio crosses above 3.5 or 4 times. At 2.45x, Consensus has immense financial flexibility.
The composition of that debt is fascinating, though. The data shows they have $348 million locked up in 6.5% high-yield notes.
Yes, that's a big chunk.
During the call, an analyst essentially asked, hey, you guys are swimming in free cash flow. Why don't you just take that cash and retire this expensive 6.5% debt early to clean up the balance sheet?
And Scott Terricci's response to that question was an absolute masterclass in ruthless corporate finance and capital discipline. This is where we really get to unpack the mechanics of their debt strategy.
I love this stuff. Walk me through the mechanics of why they wouldn't just pay it off.
These specific 6.5% notes become what is known as callable in October 2026.
Callable.
Callable is a financial term, meaning the company has the contractual right to force the bondholders to sell the debt back to the company early, before the final maturity date.
Okay.
However, the original bond contract heavily penalizes the company for doing this. It stipulates that if Consensus chooses to call the bonds early in October 2026, they are legally required to pay 101.625% of the face value to the bondholders.
I see. It's a premium penalty. It's like paying a massive fee for paying off your mortgage early.
Exactly. The bondholders want their guaranteed interest, so if you take it away early, you have to compensate them. However, that same contract dictates that if Consensus simply waits one more year, until October 2027, those exact same bonds become callable at par.
Meaning
they can buy them back at exactly 100% at face value with zero premium penalty whatsoever.
So what was Terricci's ultimate conclusion on the call?
He essentially said, look, we do not find the economics of that call price attractive. Why on earth would we voluntarily burn shareholder cash to pay a 1.6% penalty right now when we can simply remain patient for 12 months and retire the debt with zero penalty?
Makes sense when you put it like that.
It is a highly disciplined, mathematically sound move. It proves to investors that management isn't just burning cash to make the balance sheet look pretty for a quarter. They are ruthlessly calculating the exact return on invested capital for every single dollar that leaves the building.
But wait, if they are generating all this cash and they're refusing to pay down the massive high yield notes because of the penalty, what are they doing with the money sitting in their accounts right now?
Terricci mapped that out perfectly as well. They have a $64 million outstanding balance on a revolving credit facility.
Essentially a massive corporate credit card.
Right. That specific loan carries a floating interest rate based on SOR, the secured overnight financing rate. Meanwhile, the company currently has $99 million in raw cash sitting in U.S. money market accounts earning standard bank interest.
Okay, so they have the cash to pay off the card.
Terricci pointed out a mathematical reality. There is currently a negative 2 to 2.5% arbitrage spread.
Meaning they're earning less interest on their cash in the bank than they are currently paying out in interest on that revolving credit line.
Exactly. They are slowly bleeding cash on the spread. So the only logical, financially disciplined move is to take a chunk of that U.S. cash pile and immediately pay down the revolving credit facility to capture that spread and stop the bleeding.
It's not as sexy as a massive share buyback or a flashy acquisition, but it is the smartest use of capital.
Wow. We're really getting deep into the financial engineering weeds here, but it paints an incredibly clear picture. It shows a management team that is squeezing every single basis point of efficiency out of their capital structure.
They are treating shareholder money with immense respect.
It is the exact kind of granular, unemotional discipline you pray to see as an investor when a company is navigating a major strategic transition.
All right. We have analyzed the raw data. We have deeply explored the story behind the government mandates and the complex transition from flat faxes to AI-structured data.
The whole Harmony platform.
We have parsed the forward-looking guidance, the margin headwinds, and the intricate debt mechanics. It is time to bring all of these threads together. We need to tell the listener exactly what to do with this mountain of information. Let's move into our final assessment, the bottom line.
This is the moment of truth. This is where we synthesize the data, the narrative, and the valuation into a clear, actionable stance.
And I am going to plant my flag. I am taking a firm, highly opinionated, incredibly bullish stance on Consensus Cloud Solutions.
I'm right there with you.
The underlying results buried in this transcript are phenomenally strong. The headline narrative that might casually terrify a retail investor, a seemingly sluggish 4.1% consolidated growth rate, and a bleeding legacy Soho business, is actually a beautifully orchestrated financial illusion.
It really is.
The Soho decline is not a failure of management. It is an intentional, strategic, highly profitable cash cow maneuver. They are consciously milking the legacy business dry in order to fund a high-margin, highly secure enterprise growth engine that is rapidly approaching double-digit growth.
The underlying mathematics of the business unequivocally support that bullish stance.
But the truly actionable insight, The fundamental reason you should be paying acute attention to CCSI right this second comes down entirely to valuation and capital allocation.
The valuation is the kicker.
It is the ultimate screaming bullish signal. Management specifically pointed out on the call that at the current stock price, the company offers a massive 16 to 17% free cash flow yield.
We need to pause and contextualize how absurd a 17% yield is in today's market.
Put it into perspective for us.
If you go buy a highly secure 10-year U.S. Treasury bond right now, you might get a 4 or 5% yield. If you buy a massive, stable tech conglomerate like Apple or Microsoft, you might get a 3 or 4% free cash flow yield.
So 17% is just off the charts.
For Consensus to offer a 16 to 17% yield means the business is generating such an immense tsunami of cash relative to its tiny market capitalization that the stock is practically on a fire sale.
The market is pricing it like a company going out of business, while the cash flow proves it is thriving.
And more importantly, the management team knows exactly how mispriced their own stock is.
That is precisely why the board of directors just authorized an increase in their share repurchase program to a staggering $200 million. They have $118 million left in that war chest today.
Which is a huge percentage of their total market cap.
It's about that. If management continues to aggressively buy back their own stock at these highly suppressed prices, they're effectively building a massive concrete floor underneath the stock price.
It creates a brilliant, virtuous financial cycle. Because the stock is cheap, their $118 million buys a massive number of shares on the open market, which they then retire.
And what does that do?
This drastically reduces the total number of outstanding shares. When the share count plummets, the earnings per share, the EPS metric that Wall Street obsesses over, mechanically skyrockets, even if the actual net income of the company stays totally flat.
It is pure financial engineering.
It is, but it is financial engineering executed in the best possible way to enrich the long-term shareholder.
For you, the investor sitting at home looking for opportunities, this is an incredibly rare structural setup. You have a prime opportunity to buy into a highly profitable, hyper-sticky, AI-driven healthcare workflow transition play.
But precisely because the company still has the dreaded word fax lingering in its legacy history, it is perfectly disguised as a boring, dying tech stock.
The broader market is entirely mispricing the reality of their transition from simple document transport to advanced workflow intelligence.
Completely mispricing it.
But because our job is to look at all angles, I have to play devil's advocate one last time. Let's look at the worst case scenario.
Okay, hit me.
Even with the massive buybacks, even with the VA mandate locking in government revenue, does the heavy reliance on the Soho cash engine present a ticking time bomb?
It's the biggest bear argument out there.
Management guided for a 5 to 7% Soho decline in the near term. What happens if that decline suddenly accelerates uncontrollably? What if next year, small businesses abandon fax entirely and the decline hits 10%, and the year after that it hits 15%?
It's a scary thought.
Does the cash engine suddenly run out of fuel and crash the plane before the corporate engine reaches cruising altitude?
It is absolutely the most critical risk factor any investor needs to monitor quarter over quarter. But to answer your question, we just have to look at the mathematical crossover point, which actually just happened.
Walk me through the math.
The corporate segment just crossed $60.5 million in quarterly revenue. The Soho segment has bled down to $30.9 million. This means the corporate segment is now roughly double the absolute size of the Soho segment.
Right. It's a 2-to-1 ratio now.
Exactly. So think about the math of percentages. If a revenue segment that is twice as large is growing at 9.3%, it is generating far more absolute new dollars every quarter than the smaller segment is losing by shrinking at 7%.
Oh, that makes perfect sense.
The mathematical crossover has already occurred in the background. The corporate engine is now so large and so powerful that it physically pulls the entire consolidated top line upward, even if the Soho decline accelerates slightly.
So they aren't racing the clock anymore.
Management isn't desperately racing a ticking clock. Mathematically speaking, they have already won the race. The fact that the consolidated revenue growth rate actually accelerated to 4.1% this quarter is undeniable mathematical proof that the corporate gains have permanently eclipsed the Soho drag.
That makes total sense. The sheer mass of the corporate side renders the Soho decline mathematically irrelevant to the overall growth trajectory.
Exactly.
So the foundational thesis holds firm. The underlying fundamentals are rock solid, the cash generation is elite, and the valuation is severely disconnected from reality.
They absolutely are. It's a compelling setup.
Before we wrap up this incredibly deep analysis, I want to leave you, the listener with a final, somewhat provocative thought to mull over.
I like where this is going.
Something that was absolutely not explicitly stated by management on the earnings call, but feels like the logical, perhaps inevitable endpoint of everything we have discussed today.
Let's hear it.
We spent a massive amount of time talking about consensus creating an intelligent ecosystem for the entire customer continuum. We talked about how archaic legacy healthcare administrative burdens are financially strangling hospital budgets.
The unstructured data problem.
Right. And we talked extensively about the new Harmony platform sitting directly in the middle of the ecosystem, intelligently structuring chaotic data and seamlessly feeding it into massive walled garden EHR systems like Epic or Cerner.
Right. And as we established, true interoperability is the ultimate holy grail of modern American healthcare.
Exactly. So here is the thought experiment. Could a highly secure data transport company that has successfully integrated a proprietary AI workflow layer, a company that miraculously holds the elusive FedRAMP clearance, is deeply embedded as the mandated standard in the VA, and already sits inside the workflow of 67,000 massive corporate accounts, could CCSI actually become the ultimate prime acquisition target?
Oh, wow.
Imagine a massive EHR monopoly like Epic or Cerner waking up one day and deciding they want total end-to-end control over healthcare interoperability, including the fragmented outer edges of the network. Instead of continually partnering with Consensus to translate faxes, why wouldn't they just buy them outright?
It is a fascinating strategic scenario. When you look at CCSI's highly suppressed market valuation and that staggering 17% free cash flow yield, a massive healthcare tech giant could acquire Consensus tomorrow
and instantly absorb a massive sticky base of 67,000 enterprise clients.
Exactly. They would permanently own the interoperability translation layer for all unstructured medical data, and the sheer free cash flow generated by CCSI would virtually pay for the entire acquisition itself within a handful of years.
It is a highly plausible, incredibly lucrative strategic endgame.
It is definitely something to keep a very close eye on over the next few quarters as the Harmony platform fully rolls out and Steve Tolle continues to aggressively build up that healthcare strategy group.
The puzzle pieces are certainly being arranged on the board. The market just hasn't realized what picture they are forming yet.
It's going to be a fun one to watch.
Well, that is all the time we have for this deep dive. We want to thank you for joining us as we extensively unpack the Consensus Cloud Solutions Q2 2026 earnings.
Thanks for listening.
Remember, the stock market always gravitates toward a simple, easily digestible narrative. But the profound truth is almost always buried deep within the raw data. You have to be willing to do the work and keep questioning the headlines.
Because sometimes what looks exactly like a dying legacy time capsule from the outside
is actually a highly tuned, fiercely profitable, cash-generating machine on the inside. You just have to know which engine to look at. See you next time.